Hey guys, what's up? So today we are studying balance sheet. What is balance sheet? Oh my god, let's see. A balance sheet gives a statement of a business's assets, liabilities, and shareholders' equity at a specific point in time. A balance sheet basically tells you how much assets, liabilities, and shareholders equity does your business have at a particular time. Alright, so here's the format of balance sheet. It has a proper format which starts from assets. Alright, do you remember accounting equation, which was basically assets is equal to liabilities plus shareholders equity? Do you remember that? If you don't, the video will be linked in the description box. Alright, so balance sheet is basically based on that equation. What do? You make two columns. In one column you are going to write all the assets, and we have also looked at the concept behind this equation, so do check that video. Alright, on the other column you are going to write liabilities and shareholders equity. You are going to take total of both the columns, and that total has to be equal. Total assets is going to be equal to total liabilities and shareholders equity. Alright, this is your balance sheet. And now we are going to look at each category given in this balance sheet in detail, so that we understand what do we have to write and where. First is assets. Assets are usually written under two headings, which is fixed assets and current assets. Fixed assets are basically those assets that you are not purchasing for selling them. They are not purchased for the purpose of selling. They are to be used by the business, in the business, and they are expected to be of use to the business for a long time. So they are usually used for more than a year. It could be equipment, it could be furniture, it could be your building. All these things are fixed asset. They are not there so that you can sell them and earn revenue. You are obviously using them, your business is using them, and they are used for a longer time period. Alright, so fixed assets is anything. First of all, it shouldn't be bought for selling. It is used by the business, and it is expected to be of use to the business for a longer time period. Next is fixed assets example. Buildings, machinery, motor vehicles, fixtures and fittings. These are the examples of fixed assets. And while you are listing them in the balance sheet, you usually start with those things that business is going to keep for the longest time period. And then you move towards those which aren't kept for so long. Such as, first of all, there is written land and building. It's going to stay for a very long period, right? So you are going to write that first. Then comes fixtures and fittings. Obviously, it's going to stay for a longer period. So fixtures and fitting. Then machinery. Yes, machinery is going to stay less than fixtures and fittings, but more than motor vehicles. Alright, this is a rule, but it's not really followed as such anymore, but it is something, who knows, you might get it in a quiz, in an MCQs or something, so I had to tell you. But it's not really followed that much, so do know that, don't get confused over this. Next is current assets. Current assets are assets that are likely to change in the short term, and certainly within 12 months of the balance sheet date. They include items held for resale at a profit, amounts owed by debtors, cash in the bank, and cash in hand. So current assets are basically those things that are likely to change within 12 months, that you might spend them, you might use them. All those things are current assets. By the way, you do know what are assets, liabilities and shareholders equity, right? If you don't, videos are linked. Come on, go check them first. So you have all the basics in your mind, and then you can learn these things. Now comes liabilities. Just like assets, there are two categories of liabilities. First one is current liability and second one is long-term liability. Current liabilities are those which have to be paid within a year of the balance sheet date. Alright, all those liabilities that you have to pay within a year are your current liabilities. Bank overdrafts, amount due to creditors. They are not giving you amount for forever. Yeah, just keep it, man, keep it. Keep purchasing goods and don't pay us. We are not here for business. They are not saying that, obviously. You have to pay them ASAP. Alright, so yeah, whatever liabilities that you have, that you have to pay those within a year, then you have to write them under current liabilities. Then long-term liabilities. Long-term liabilities are items that have to be paid more than a year after the balance sheet date. Example, bank loans and loans from other businesses. When you take a lot of loans, and bigger loans, then they are usually to be paid within maybe 2 years, 3 years, 5 years. It can go quite a long way. So yeah, those are your long-term liabilities. Then there comes owner's equity. Owner's equity is money currently held by your company. It shows what belongs to the business owners. Alright, so it includes your capital, private or public stock, retained earnings. Alright, that's your owner's equity. And whatever comes from income statement, it could be a loss, it could be a profit, you have to add or subtract that in owner's equity. If it's a loss, obviously you are going to subtract it from owner's equity. But if it's a profit, you are going to add that over here. Once again, do look at the format. It's very easy, it's very simple. Now we are going to do an exercise and we will see how we can make a balance sheet. This question would actually be very easy. I'm thinking about making more videos and doing more questions, but I'm not sure if you guys want that. If you do, let me know in the comments below and I will make more videos with tougher exercises, better exercises, where we are only focusing on exercises of balance sheet, income statement, trial balance, and so and so. Alright, so here is our question. This is basically balances have been taken from ABC on December 31, 2017. Alright, you can see all the accounts that have been given to us. Total cash, accounts receivable, merchandise inventory, prepaid shop rent, sales equipment, allowance for bad debts, accounts payable, and capital. Over here, we have to see one thing, that merchandise inventory is of January. Alright, it's not of December. It's 1st January 2017. Basically, when the year started, you had this much merchandise. But now, year has ended. So, there will be extra information given in which merchandise inventory for 31st December will be written. Don't worry about it, but make sure that you are writing the correct inventory whenever you are making a balance sheet. Another thing, it's written debit credit, but in balance sheet you don't see that a lot, and you don't have to worry about it. You just write the things as per the format. But if you don't know the concept of debit and credit, then the video will be linked in the description box. I know I'm saying that a lot, but I just want you guys to understand everything. So when you actually go for your exam or practice, you are able to understand everything. Once you know the basic concepts, then you are very likely to gain good marks, as well as you will actually understand things, which is a good thing. So here is some extra information. They thought, hey, you should know these things as well. Prepaid shop rent, unused office supplies, salaries, and okay, we'll do each of them and we will discuss each of them while writing them in our balance sheet. Balance sheet, asset. First of all, you write current asset. We just saw it in our format, so you know this. Alright. So cash. First thing we are writing is cash. Cash 5,000. It was written in our balances. And there was no extra information written regarding cash in our extra information. Alright, so we wrote cash. Now if you are doing exam, do know there will be a lot of extra entries that you may not need for your balance sheet. And you have to make sure to see that what you should write, what you shouldn't write. Maybe purchases are given, but you have already calculated purchases in our income statement. You don't have to write that. Now you are only going to write net profit or net loss from that income statement. But purchases are not required in your balance sheet. So there could be such things. Hence, make sure that you are taking correct entries as well as highlight those which you have already written in your balance sheet. So you don't write them again and again, and there's less confusion and you know exactly what you have already recorded in your balance sheet. Next thing, accounts receivable, it's going to come as it is, that is 10,000. Yes, do you see it here? Of course you do. It's 10,000. Next, there is less allowance for bad debts. I see. So basically, allowance for bad debts is that how much money we might lose. It's basically how much money that you may not get from accounts receivable. Maybe some customer left the country. You cannot move towards that country just to get your $500, right? That would be stupid. Or let's say someone went bankrupt. You cannot force them to do anything. They don't have money. How are you going to take money from them? So there's always a small window where you say, alright, I may not get this amount from my accounts receivable. This is calculated. There are a lot of ways of calculating it, but it is usually calculated by observing the previous losses we had with accounts receivable. In this question, we were already given allowance for bad debts, so we just subtracted it from accounts receivable. Here you can see allowance for bad debts is given. Now we are going for merchandise inventory. But as I said, we are not going to write January 1. We are going to write December's merchandise inventory. Oh my god, see? Over here we had January 1, which was 8,000. Extra information, merchandise inventory valued on December 31, 10,000. Now current value on December 31 is 10,000, so you are going to write 10,000 only. So here it is. Now office supplies 400. We had office supplies remaining. As you can see, extra information said unused office supplies. You are obviously going to use it, but it's an asset. Alright, so unused office supplies 400. We are going to write that under current asset. Ta-da! See? Prepaid office rent. Prepaid means you have already paid it, but you haven't used that thing yet. You haven't stayed in office for the amount that you have paid. 1,000 is still remaining. That's your asset. This is something you gained. You gained a space for giving 1,000 and you still have time left for it. So prepaid office rent 1,000, it's an asset. And it was already given prepaid office rent 5,000, but in extra information it said prepaid office rent is 1,000. Alright, so what are you going to write? You are going to write prepaid office rent because this usually extra information comes on the day. Like December 31st, they calculated a few things and they gave you. And they said now, alright, you can see through everything and you can see what we have to write or what we don't have to write. Alright, then prepaid office rent, we have discussed that, right? Now we are going to go for non-current asset. Now at this point you have to make sure that have you written all the current assets in your balance sheet. If you have, awesome. If you haven't, you should write it and you should look at it. Alright, and it would also be a good idea to write total current asset over here. I haven't written it. I don't know in what world I was living in, but yeah. So now we are going for non-current asset. First thing, sales equipment 30,000. Oh my, it was already given, so we don't have to do anything. Alright, but then we were also given allowance for depreciation at sales equipment 2,000. We have to subtract that amount. Alright, so depreciation is a topic on its own and it deserves obviously a separate video. We will discuss it in detail and we will also see what are the methods through which you calculate depreciation. But in this video, I do want to give you a small concept of what depreciation is. It's very simple, it's very easy. Basically, you bought a laptop. You were really happy. It was for 50,000. You said, alright, the life expectancy of this laptop is 5 years. Life expectancy as in it's going to work for you for maximum 5 years. After 5 years, it has given you the value of your money and it has worked as much as it could. And if it still works, that's your good luck. But if it doesn't, you will be like, alright, that's okay, it worked for me for 5 years and now I can get a new laptop. But let's assume in third year you wanted to sell this laptop. Would you sell it for 50,000? No, obviously not. It's not valued at 50,000 after you have used it for 2 years. It is going to depreciate. It is going to decline its value. In fact, from the moment you bring your laptop from shop to home, it has already lost a lot of value. You are reselling it. Nobody is going to purchase it from you for 50,000, right? So, same goes for all the properties that a business has. Same goes for all the fixed assets that a business has. You are supposed to depreciate everything so that whenever someone looks at your asset, they know the actual value of your assets. Alright? So over here we don't have to calculate it. We are already given allowance for depreciation at sales equipment 2000. This is given to us in extra information. So we are just going to write less allowance for depreciation. You are going to minus this amount from sales equipment so that you can see what's the value of sales equipment on December 31st, 2017 and onwards. What's the value? It's 28,000. Alright. Now we do not have any other non-current or fixed asset. However, if you have it listed, you have to add it. Over here we are just going to add all these and look at the total asset value. Total asset value is 53,900. Yay! And we have created one side already, so we are done with assets. Now we are going to go for liability and equity. Current liabilities, obviously just like assets, we are first going to list current liabilities, and then if we have any non-current or long-term liabilities, then we are going to write that. First liability is accounts payable. We were already given this in our balances. It says accounts payable 6,000. Do we have any extra information regarding accounts payable over here? So you are just going to write it as it is. Accounts payable 6,000. Now next current liability is salaries payable. It was already given to us in extra information that salary is outstanding. Means we have to pay these salaries, and people, our employees, have already worked for us, but we have to pay it. This is a liability on us. So we are going to write salaries payable 5,000. Next is unearned commission. Alright, you might be confused why we are writing it over here. Because it's a liability. They gave you money but you haven't worked for it, and it's still unearned. You have to work for it. You have to do whatever they wanted to do for which you got this commission. So whenever you will complete this work, you will take it from liabilities and put it in your cash. That this is not a liability anymore, we have already worked for it. However, for any XYZ reason, you are not able to do that work, then you have to pay this money back to the person who paid you already. Alright, unearned commission. You haven't earned it. Someone gave you money already. You are going to put it in liability because this is a liability. You haven't earned it yet. But when you do, you will move it to cash. Alright? Alright, that's it for current liabilities. Do check once if you have listed everything. And if you have, awesome. Now we are going to go to the equity. Again, it would be a good idea to write total current liabilities. Yes, I'm a stupid person who didn't do it. But since I'm usually in a hurry, I often forget these things. That's why I have given you guys a proper format and you can check that. So, equity. Were we given any equity? Oh yes, we were. We were given capital. Capital is 30,000. Let's write that. Capital 30,000. Next, we are going to write net profit. Were we given any net profit? Yes, we were. We were given net profit in our extra information. It comes from what? Income statement. And it's a profit. So you are going to add it. Now we got 41,900, which is our total equity. And you are going to add all the current liabilities with equity. Total equity. So total equity plus total current liabilities is equal to 53,900. Our balance sheet is balanced, which means we have done this question perfectly. And if you want me to do more exercises like this and maybe go in more details, A lot of times they are very confusing questions. Let me know in the comments below and I'll make a video on it. And that's it for this video. I really hope you guys enjoyed it. If you did, make sure to give this video a thumbs up. Do subscribe and share, and I will see you guys in my next video. Bye guys.